Welcome to our deep dive into the shadowy world of stock market manipulation. It's a bit like Las Vegas, except instead of losing your shirt at a roulette wheel, you might lose your retirement savings to a guy in a Patagonia vest whispering sweet nothings about a sure-thing penny stock. Today we'll uncover the tactics used by manipulators to deceive investors and disrupt the market. We're talking about the kind of people who would sell their own grandmothers for a fractional bump in their portfolio, so buckle up because we're about to expose the dark underbelly of the financial world. Imagine a group of people whispering about a hot stock tip at a cocktail party. They're talking about a tiny company, maybe something with blockchain or metaverse in the name. Now imagine these whispers spreading online, on message boards, social media, maybe even disguised as independent financial advice. That, my friends, is the first stage of a pump and dump scheme. These manipulators, who likely bought the stock for pennies, are artificially inflating its price through hype and misinformation. They're creating a mirage of demand, hoping to lure in unsuspecting investors. These new investors, blinded by the promise of quick riches, pile into the stock, driving the price even higher. Once the price is right, they dump their shares, cashing out and leaving everyone else holding the bag. The price plummets, the hype evaporates, and those left holding the stock are left nursing their financial wounds. If pump and dump is about manufactured optimism, short and distort is its cynical twin. It thrives on fear, uncertainty, and the kind of negativity that would make a Twitter comments section look like a self-help book. Here, our manipulators are betting against a company. They're shorting the stock, which means they'll profit if the price goes down. But rather than wait for the market to do its thing, they decide to give it a little push. They spread rumors, plant fake news articles, and flood online forums with negative comments. As fear takes hold, investors start selling, driving the price down. Our manipulators then buy back the stock at a lower price, pocketing the difference. Imagine walking into a bakery and seeing a line out the door. You assume they must have amazing pastries, so you join the queue. But then, just as you reach the front, everyone in front of you suddenly vanishes. It was all an illusion, a cruel trick designed to manipulate you. That's essentially what spoofing is, but instead of croissants, we're talking about stocks. Manipulators, using sophisticated algorithms, place large orders for a stock. But here's the catch: they never intend to actually buy or sell. These are phantom orders, ghosts in the machine, designed to create the illusion of demand or supply. Other traders, seeing these large orders, might assume something big is happening and react accordingly. The manipulators then cancel their orders and pocket a profit. Let's talk about trust. You trust your doctor with your health, your mechanic with your car, and your financial advisor with, well, your finances. But what happens when that trust is broken? That, my friends, is the ugly reality of churning. Imagine this. You're sitting in your broker's office discussing your investment portfolio. They're using words like synergy and diversification, and you're nodding along, pretending to understand what they're talking about. But behind that veneer of expertise, your broker sees you as one thing: a cash cow. They start making excessive trades in your account, buying and selling stocks with reckless abandon. They don't care if these trades align with your investment goals or if they're even in your best interest. All they care about is generating commissions for themselves, even if it means chipping away at your hard-earned savings. Have you ever walked past a movie theater and seen a line wrapped around the block, only to discover later that the movie was terrible? That's the power of perception. And in the stock market, perception is everything. Enter wash trading, a manipulation tactic designed to create the illusion of activity and interest, even when none actually exists. Imagine a manipulator buying and selling the same stock to themselves repeatedly. Each trade, while ultimately meaningless, gets recorded on the stock exchange. This creates a false sense of volume and liquidity, making it seem like the stock is more popular than it actually is. Other investors, seeing this flurry of activity, might be fooled into thinking something big is happening. The manipulator, having created the illusion of demand, can then sell their shares to unsuspecting investors at an inflated price. It's dishonest, it's manipulative, and it's about as effective as trying to convince people that Nickelback is the best band ever. Imagine a pack of wolves circling a lone elk, slowly wearing it down with each coordinated attack. That's the basic idea behind bear rating, but instead of wolves, we have investors, and instead of an elk, we have a company's stock price. This isn't your average short selling. This is a full-on coordinated assault designed to drive the price of a stock down to the depths of financial despair. These raiders, often working together in secret, start by aggressively short-selling a stock, borrowing shares, and immediately selling them, hoping to buy them back later at a lower price. But they don't stop there. They spread rumors, plant negative news stories, and generally try to create a climate of fear and panic around the company. This relentless selling pressure can trigger a domino effect. Other investors, seeing the price plummeting, might panic and sell their shares as well, further driving down the price. Let's play a game. Imagine you're playing poker, but you can see everyone else's cards. You'd win, right? Of course you would. It wouldn't be fair, it wouldn't be ethical, but you'd win. That's essentially what insider trading is, using non-public information to gain an unfair advantage in the stock market. Imagine a corporate executive privy to confidential information about their company's upcoming merger, or a lawyer overhearing a juicy tidbit about a pending lawsuit. These individuals have access to information that the public doesn't, information that could significantly impact a company's stock price. Now imagine them using that information to their advantage, buying or selling stock before the news becomes public. It's like finding out the answers to a test beforehand and then acing it. Imagine you're at a restaurant and you tell your waiter you're craving the steak. But before you can even finish your sentence, the waiter rushes to the kitchen, orders the steak for themselves, and then charges you double when it arrives. That's the basic premise of front-running, where brokers take advantage of their clients' orders to make a quick profit. Let's say you're a client and you tell your broker you want to buy a large number of shares in a particular company. A decent human being, let alone a broker bound by ethical and legal obligations, would simply execute your order. But a front-running broker sees an opportunity. They know your large order will likely push up the price of the stock. So they buy the stock for themselves first, then execute your order, ensuring they make a tidy profit at your expense. Imagine trying to have a conversation in a room full of people shouting gibberish. It'd be impossible to hear anything, let alone make sense of the chaos. That's kind of what quote stuffing does to the stock market. It's like a DDoS attack. But instead of targeting websites, they're targeting the very systems that make trading possible. These manipulators use sophisticated algorithms to flood the market with a barrage of orders, often thousands or even millions per second. These orders aren't meant to be executed. They're just digital noise, designed to overwhelm trading systems and create confusion. This flood of information can slow down trading platforms, making it difficult for legitimate investors to buy or sell stocks. In the midst of this chaos, our manipulators can then swoop in and exploit the situation. They might be able to buy stocks at artificially low prices or sell at inflated prices, all because they've effectively blinded everyone else. We all love a good secret, a juicy piece of gossip whispered behind cupped hands. But when it comes to the stock market, those whispers can have serious consequences. Insider information leaks, the act of selectively disclosing confidential information for personal gain, are like financial grenades capable of exploding a company's stock price and leaving investors scrambling for cover. Imagine a CEO sharing confidential earnings information with a friend at a golf course, or an analyst leaking details about an upcoming merger to a select group of clients. These leaks create an uneven playing field, where those privy to the information can profit at the expense of everyone else. It's like giving someone the answers to a test while everyone else is still struggling to solve the equations. Those who receive this leaked information might buy or sell stock, knowing that the price is about to move significantly. By the time the information becomes public, the damage is already done. Understanding these tactics helps investors protect themselves and promotes fairer, more transparent markets. Think of it like this. If you know how con artists operate, you're less likely to fall for their tricks. Stay informed, stay vigilant, and always do your due diligence. Don't believe everything you read online, especially if it comes from a stranger promising you riches beyond your wildest dreams. Thanks for watching, and don't forget to like, share, and subscribe for more insightful content. Because remember, in the stock market, knowledge is power, and ignorance is a portfolio on fire.